What if one wrong tax belief is costing you more money every year than a pay raise can fix? Not because you are careless, but because the rule you trusted was never fully true. Taxes are confusing on purpose. Rules change quietly. And a lot of people follow advice from friends, social media, or one random article, then later realize it pushed them in the wrong direction. In this video, we are breaking down 5 common tax myths that hurt your money. You'll also learn the simple truth behind each one, so you can keep more of your hard-earned dollars working for your future. Let's get started. 1. A mortgage automatically saves you on taxes. A lot of people believe this. I should keep my mortgage because I get a tax deduction. The idea sounds smart, and sometimes it can be partly true. But for most people, it does not work the way they think. Here's a key point. Mortgage interest only helps if you itemize deductions. If you do not itemize, your mortgage gives you zero tax benefit. Now let's explain why itemizing is harder than people think. The government gives you a standard deduction. If you cannot build itemized deductions above that level, you just take the standard deduction. Even if you do itemize, there is another mistake people make. They think the deduction means the mortgage saves money. It does not. A deduction only reduces taxable income. It does not erase the interest you pay. Here is a simple way to think about it. If you have a mortgage and also money sitting in a bank account, you might say, I will keep the mortgage because it helps my taxes. But your real question should be this. What rate are you paying on the mortgage versus what rate you earn in the bank? There was a time when this comparison looked better, but that does not make mortgage equals tax savings a permanent rule. It depends on your numbers, your rates, and whether you itemize. So what is the real truth? A mortgage can reduce taxes only in specific situations, mainly when you itemize and when the interest is actually pushing you above the standard deduction threshold. The smarter move is to stop assuming and start calculating. 2. If you gift more than $19,000 a year, you pay gift tax. This one scares people. Someone hears a rule like $19,000 per year and thinks anything above it triggers a tax bill. That is not how it works for most families. Here is a clean truth. The $19,000 number is often the annual gift reporting threshold per recipient in the data we are using. If you give someone $19,000 or less in a year, you generally do not even need to report it on a gift tax return. If you give more than $19,000, that does not automatically mean you owe gift tax. It usually means you may have to report it, and the amount above the annual threshold counts against your lifetime gift and estate limit. That lifetime limit is massive. The key idea is this. Most people will never come close to gifting enough to actually owe federal gift tax. So, why does the myth stick? Because people confuse two different things. Reporting versus paying. Reporting does not automatically mean you owe tax. Let's make it simple. If you give a little more than the annual limit, many people panic and think the extra amount gets taxed. Usually it does not. It is usually just counted toward the lifetime limit. The main message is this. Do not let the $19,000 number scare you. For most people, the bigger issue is planning the right way to give, not fearing a tax bill that likely will not happen. 3. Pre-tax 401k contributions save you taxes forever. This is one of the most common misunderstandings in tax planning. People say, I put money into my 401k pre-tax, so I save taxes. Sometimes that is true, but often what really happens is you delay taxes. Here is the clear truth. A traditional pre-tax 401k usually reduces your taxable income today. That can lower your tax bill now, but the money is not tax-free. Taxes are waiting on the other side when you withdraw in retirement. This matters because a lot of people look at a retirement account statement and think every dollar in that account is fully theirs. But the account is pre-tax. Part of it belongs to future taxes. A strong example from the data is the idea of someone proudly saying, I saved $1 million. But if they are in a tax bracket like 25%, then a big chunk of withdrawals will eventually be taxed. So it is not the same as having $1 million in a checking account where taxes were already paid. So when does pre-tax actually save you money? It saves you if your tax rate later is lower than your tax rate today. For example, If you avoid taxes at 22% today and later withdraw at 12%, that difference is real savings. But if you avoid 12% today and pay 12% later, you did not save. This is why the myth is dangerous. It can make you overconfident. It can lead you to put everything into pre-tax buckets without thinking about future taxes, changing laws, and retirement income. There's another layer that shows why you cannot use blanket rules. Your adjusted gross income affects credits and thresholds. In the data, there's an example where someone earns very high income and asks whether to contribute pre-tax or Roth. In some cases, pre-tax contributions can reduce income enough to qualify for something valuable. So here is the real lesson. Traditional 401k contributions can be a great tool, but they are not a magic tax savings button. They are a timing tool. Use them with a plan, not with a slogan. For bonuses are taxed at a higher rate. Many people see their bonus check and feel disappointed. They say, my bonus got taxed more. Then they decide bonuses are unfair, or that working harder is not worth it. Most of the time, that belief is incorrect. Bonuses often have higher withholding. Withholding is not the same as your final tax rate. In the data, there is discussion of employers withholding a flat percentage on bonus-type payments. When you see a larger chunk withheld, it feels like the bonus is taxed more. But the real tax you owe is based on your total income for the year, minus deductions, and then applying the tax brackets. So what does this mean for you? It means a big bonus withholding could simply lead to a bigger tax refund later, or it might help cover taxes you would have owed anyway. The bonus is not automatically taxed at some special higher tax law rate just because it is a bonus. The real truth is that the bonus is income and it flows into your overall income picture. Your final tax outcome depends on the full year, not one paycheck. 5. If you are in the 22% bracket, all your income gets taxed at 22%. This is one of the most harmful misunderstandings because it affects almost every decision people make. People say, I am in the 22% bracket, so I pay 22% on everything. That is not how a progressive tax system works. In a progressive system, income is taxed in layers. The first chunk is taxed at the lowest rate, then the next chunk at the next rate, and so on. The data mentions common bracket steps like 10%, 12%, 22%, 24%, and more above that. So if you are in the 22% bracket, it usually means only the top part of your income is taxed at 22%. The earlier portions are taxed at lower rates. This is called your marginal tax rate, not your overall effective rate. This myth can cause bad decisions. Someone might avoid earning more money because they fear moving up a bracket, or they might make the wrong move on deductions and retirement contributions because they do not understand what rate applies to the next dollar. It also affects planning ideas like Roth conversions. If you know where the edges of your brackets are, you could decide how much conversion makes sense without spilling into the next bracket. So the real truth is simple. Your bracket label does not describe your whole income. It describes the tax rate on your last dollars of income. When you understand this, your money decisions become clearer and less emotional. Taxes do not need to scare you, but tax myths can quietly drain your money for years. The goal is not to become a tax expert overnight. The goal is to stop making decisions based on half-truth ideas. A mortgage does not automatically save you taxes. Gifts above $19,000 do not automatically create a tax bill. A pre-tax for a 1K is not always permanent tax savings. Bonuses are usually withheld differently, not taxed differently. And your tax bracket is not one flat rate on everything you earn. If this video helped you, take one simple step today. Pick one myth you believed and replace it with the correct rule. That one change can protect your money every year going forward. And if you found this video useful, make sure to like, share, and subscribe to the channel for more simple and practical tips about money and building a stronger financial future. Turn on the notification bell so you never miss a new video. Thanks for watching, and I will see you in the next one.